I'm Sharon Strickland, Business Development Manager for Advantage Asset Management. And today we're starting a series of short videos about the state of the market in the Houston area and to update our current owners and potential owners on different trends that we see moving forward. We will be doing future videos, and so we welcome your feedback about those and what might be interesting to you as far as those are concerned. Today I have with me Charlie Roseland, who is the president of Advantage Asset Management, and David Shine, who is our broker and counsel. Thank you, gentlemen, for joining us. We sure appreciate it.
Thanks, Sharon.
The first question is for you, Charlie, and I guess it's one that's on everybody's mind. The market is crazy right now, up and down, huge swings, constantly changing hourly, it seems. So does that make sense? Does it make sense still to invest in such a market, and if so, why?
No, it is a great question, one that I get often from not only some of our clients, but from family members and close friends even. And I'll be honest, it is difficult to know where to put money to work right now in these volatile environments. Like you said, stock market seems like it's changing on a whim, daily, hourly even. And so it makes it difficult to say, well, let's feel comfortable putting money into that versus bonds, cash, real estate, all of the options. I will say, I think diversification in general is very important. So diversification of your investments, be it if you're investing in stocks, you don't want to just invest in one or two stocks. You want to have diversification so that if there are some swings with individual companies, you're kind of protected on the downside a little bit. But it's true if you take it from a broader perspective as well, not to just invest in stocks, but look at other ways to put money to work. And especially if you're in a volatile market, you need to make sure that you're diversified, because if the stock market is crashing, that could be bad if that's the only place you have your funds. So I do think real estate is a very viable option. A couple things related to that. Texas right now is the third youngest state in the United States. The median age is only 34.4 years old, which if you have a younger population, typically that means you're going to have more renters in place. The ability for somebody that's under the age of 30, hasn't been working very long, to actually go out and buy a house, you can clearly understand that being a little more difficult. So if somebody has the means to buy an investment property, you've got a pretty wide ready market of renters ready to go. And another factor related to that is that income in the United States in general, and it's true for Texas as well, it is increasing amongst the middle class and the lower middle class. However, it's not increasing as quickly as what real estate prices are. So even though there's been some recent reports that come out that the middle class income is finally growing, it's still getting further and further away from them to be able to buy real estate and actually buy their home. So again, that kind of lends itself to renting a home. So there's a lot of factors, and everybody needs to look at their own investment portfolios to really make sense about if they want to put money to work in real estate versus stocks versus cash or whatever it may be. But in summary, I do think that real estate right now is a good investment and a good hedge, especially if we get into an inflationary type environment, that you can really justify putting money there, in my opinion, at least a lot better than putting money into the crazy stock market right now.
That makes sense.
Yeah.
Okay, the next question's for you, David, and I gotta tell you, I get asked this all the time, like in the grocery line, everywhere. Is the Houston area still an investor-friendly market?
Yes, and but it still requires caution. The famous saying in real estate: location, location, location. You can buy in one subdivision and buy a dog, and you buy another subdivision and have a winner. And so, a couple of different observations. One of the things is the Houston market did not suffer nearly as much as the rest of the country in the 08-09 downturn. At the same time, we had a downturn in 2015, 2016 due to the oil price crash that the rest of the country didn't necessarily experience. So our market is not the national market. Having said that, the Houston market, even with the 15-16 downturn, is doing very well. And so those of us who own rental real estate are enjoying solid equities. For some people that have bought in with higher mortgages and plan to keep the investment properties, this may be a good time to refinance those properties at lower interest rates, some of the lowest we've had in several years. People who are thinking of selling, it's a seller's market. Now, usually when you have a seller's market, it's not an investor's market. So I think investors need to be more careful. It may be time for investors who are looking at turning over parts of the portfolio to consider selling and then holding the equity, buying back in the next time the market dips, something like that. But as Charlie explained, it's an excellent market. We have a lot of young people. The growth in the market of just sheer bodies and employees is very good. So it's pretty optimistic from the standpoint, if you buy a rental property, that you will have tenants and you'll be able to get a reasonable rent, keeping in mind, however, that Houston historically is not the highest priced real estate market, which also means it's not the highest priced rental market. So there may be, one of the things I recommend to investors is to always have some cash on hand. Don't put your very last dollar into your real estate investments, because if there is a vacancy for several months or some type of market reversal, you need to be able to financially withstand that.
I think that's a thing a lot of people don't really plan for, so I think that's really good advice. Okay, the next one is for you, Charlie. So have the trends in the oil and gas market been a factor in the local rental market?
Dave actually kind of touched on that a little bit with the downturn in kind of 14, 15, 16, that did affect things in the local market that really didn't affect outside of the Houston area as much. But just kind of taking a step back, Houston itself has diversified. We have a very large medical industry here. Just around our office in general, we have some new hospitals that have been built, new office spaces for doctors, kind of small offices. So we've actually even got some initiatives close to downtown in the tech industry, trying to bring more tech business to Houston. So there is some diversification, and Houston has gotten away from being a pure oil and gas town. But at the end of the day, we are very much tied to oil and gas and the energy industry. The U.S. is actually now the largest global producer of oil. We've actually surpassed Saudi Arabia and other Middle Eastern countries as far as production of oil goes. And Texas itself is an extremely important part of that. It's actually kind of interesting. If Texas was a country, it would be the 6th largest producer of oil in the entire world. And of course, Houston is the hub of that from both the U.S. Production standpoint overall, Texas clearly, but then we also have a lot of international companies that have U.S. headquarters or large U.S. operations that are based out of Houston. So while we've diversified, we're still very much tied to oil and gas. But it's not completely a bad thing. The oil and gas industry since 2016, when it started to kind of recover a little bit, has mostly been, at least the oil price itself, has mostly been between $40 and $60. And the U.S. has become extremely efficient at producing oil. And so what that means is that although $40 to $60 in the past might have been a price that would not encourage any kind of investment, now we actually have the ability, and our companies have the ability to make good profits at that $40 to $60 range, especially above the $50 range. And investment has come back. Job hiring has come back. And companies that have shut down plants or maybe kind of stored plants away for a little while are starting to get those going again. Even in the local Conroe area, Tenaris is one that is a very large company, Halliburton, Baker Hughes, that have all hired on and increased their population recently of employees. So that $40 to $60 range, like I said, is actually one that has worked for investment purposes. And based off of the oil futures pricing and all the kind of investment guys that really study this stuff, they're still seeing, if you look at the pricing, kind of that $40 to $60 range or band being what's going to, at least for what we can predict, for the near future, that's where we're going to be. So again, that $40 to $60 range, although it's not going to make things go crazy, an amazing investment, it's one that will encourage at least investment and encourage job production growth here. And of course, those are typically good paying jobs, both from a blue collar standpoint and a white collar standpoint. Your guys in the manufacturing side, guys out in the field are making decent money, and then you have a lot of engineering, a lot of financial services, things like that. Again, from a job market perspective, that $40, $60 band, although not going great and crazy, is still one that is encouraging.
Okay, well, the last one's for you, and I'm going to ask you to get your crystal ball out here. How is the lowering of interest rates by the Fed going to affect investment properties?
Well, it's a positive, generally speaking. When the Fed lowers interest rates, it tends to stimulate business. And stimulating business, generally, whether you're in the real estate business or another business, generally it's good news, especially because interest rates have a direct impact on investors. We're spending more money when we buy properties, if we buy a group of properties or buy larger complexes and so forth. So interest rates allow the investor to charge lower rents because their overhead is lower, and allows them to get into properties with lower down payments and things like that. So overall, it's a positive. My personal projection is that the market had already priced in the quarter point drop recently. I would say that with the current disruption in the market, concerns about overseas, that it's quite possible that the U.S. in the next quarterly meeting of the Fed could lower the interest rate, say a half point or something like that. So again, I don't have a crystal ball, can't directly predict, but even at current rates, interest rates, we're getting interest rates under 4% for traditional first mortgages. That is usually an easy benchmark to say people can get in. Now there's some ways to play with that. If you're a single family owner and you see the market doing well, you see a house you want to move up to, it's easier to buy that next house and with less money, and therefore it may allow a family that might not normally be able to afford to rent their current residence to move that house into a rental market rather than sell it in order to get the money to buy the next house. So there's some interesting things on the small investor stage. But the large investors, of course, will be more affected by the Fed directly, and I think it's very positive for them. At the same time, it means there may be a little bit of price bidding because there may be more investors in the market. Texas is no stranger to out-of-state buyers. We have had in the past, because real estate's so expensive in California, the Houston market has had a lot of California investors. I think in the last year or so, a lot of them have backed off because our prices have come up. But again, with such a differential, we may see California buyers back in if interest rates stay down and the Houston market stays more moderate relative to the unfortunately runaway market in California.
Well, thank you, gentlemen, for your time this morning. We hope you found this video informational and helpful, and you can find it on our website, which is www.themanagementpros.com. We hope that we'll see you again for future market updates. Thank you.